Welcome to Stock Talk with Nico Kritikos. Today, we're going to be going through a stock called Middleby. This is a company that is one of the leaders, if not the biggest, in the manufacturing of cooking equipment. And some of their businesses they work with are companies like Dunkin', Burger King, Domino's, Five Guys, and Kroger. Out of the top 100 best rated food service chains, they work with 97 of them. So what this company does is, this is what their equipment looks like. They make everything from grills, they make all these different food processing products, all these different things. Okay. So it looks like they are the largest global manufacturer of these type of, equipment. And last quarter, they bought out a company called Masterbuilt, which is the leading brand in outdoor grills. They paid $385 million for this company, while that company is expected to do about $250 million in sales for the previous year. So we're going to go through and see if the stock is at a good valuation and is the fundamentals of the company in a healthy state. So first up, is the stock down or oversold? Well, no. Surprisingly, this is one of the only stocks out there right now that is actually up on a one-year basis, and it's up 38% in the past year. Previous to that, it looks like from 2017 to 2021, it didn't really move much at all. That was the only bad thing. So that gets a no. Next up, if we look at revenue and net income, we can see right here that revenue has been growing very nice from 2014 to 2019. 2020, of course, there was a slump, and then it's picked back up in 2021. But net income has continuously got stronger, and so is revenue. So those are both going to get a yes. Then we go to, does it have a healthy price to sales and price to earnings? And they're trading at a forward PE of about a 20, which is, right in line, probably in the lower end of things, and a price to sales of 3.4. So both of those numbers are pretty healthy, pretty low, especially considering the fact that price to sales revenue is expected to grow 29% this year, and EPS is expected to grow 57%. So that's pretty high growth for a company that trades at a pretty low price multiples. And then we have, is the company innovative? Do they have a moat? I put yes, they do have a moat, because once again, they're the world's biggest manufacturer of these products, and they're also innovative, because if you look on their website, you can see there's an innovation section, and they go through like how they're making these ghost kitchens and how they're making all these different things, internet connected products and all these different innovative things. Okay, so they make ovens and fridges and all these types of products. So I put that as a yes. Then we have, is it a growing industry? Yes, of course. Restaurants it looks like they're growing their customer base. They're growing, the restaurant industry is growing. So there's going to be more restaurants that need their products. And then you also saw they acquired that grill company, and that is a area that's supposed to grow as well. Next up, return on invested capital of 22%, according to this website, which 22% is very high. That's a pretty good number. Right here, you can see 22%, return on equity of 20%. So that's going to get a check. Healthy margins. Margins are looking good too. 14% profit margin is higher than most companies. Healthy cash flow. Yes. If we go to the cash flow statement, we can see right here that, so I like looking at operating cash flow, free cash flow, and then end cash position. So end cash position's gone up. Operating cash flow has consistently got better, and free cash flow is growing too. This past year, they did $512 million of free cash flow. So pretty good for a company that trades at a $10 billion company. Then we have diverse revenue streams. Yes, I put they have multiple different product lines, right? If you look at if we look at a list of their products, let's see, here's their brands. You can see they have so many different things they make that it's a pretty diverse product line, as well as all the different customers. If they lose, let's say Burger King decides they don't want to use them anymore, that would be a big hit, but still they have, all these other big brands working with them. Then next up, we have the balance sheet, and it looks like the balance sheet is pretty strong. There's more assets and liabilities. Equity seems to be growing pretty nice, 1.6 billion in 2018, and today we have 2.3. So that's good. And current assets are more than current liabilities. Current non-current assets are bigger than non-current liabilities. So that's all great. And then once again, the equity number compared to the market cap is also fairly high. So we have $2.3 billion of equity on the balance sheet, and the company trades at a $10 billion valuation, which is that's pretty good. That's that's around a 20%, more than 20% of the market cap is in equity. So that's good. And this is a company that, before the pandemic, they were doing what? Around $2.5–3 billion of revenue. That's a lot. Then we have, do they have a strong share buyback or dividend? No, they do not. No dividend, which I was kind of expecting a company like this to pay a dividend. That's what is kind of disappointing, was if this company could easily be paying a 2 or 3% dividend. And if they were paying a good dividend, this would be one I'd be interested in investing in. But I don't know. This doesn't really seem like too much of a growth company. Just seems like a value stock. And so for that reason, I'm not too interested. Share change, pretty much break even, nothing too special there. Then we have is big money or insiders interested. Insiders were not buying, but if you look at the hedge funds, you can see there are big hedge funds that own this stock. So here we have Vanguard with over $1 billion, BlackRock 800 million. So you have big funds buying in. And then is it founder led or good management? It's not founder led. This is an older company, but it looks like they have good management. Their return on invested capital is super high. I think the CEO has been there for over 25 years. And a lot of times you just kind of go through the interviews, listen to what they have to say, see the kind of decisions they're making. They're making acquisitions like that grill company they bought out. That's a good sign. So you kind of just got to pay attention to the decisions they make. But yeah, so all in all, we have a score of 16 out of 18, which is super good for a company. And so this stock is going to get a pass. It's going to get a buy, even though I don't think even though they're growing revenues a lot and EPS a lot this year, but I don't know. I still don't see this. I don't think that's a permanent thing. I think this is a company that's normally going to do 5 or 10% growth. So that's why I don't really see it as a growth company. And maybe if it went down a lot, if it came down to $100, maybe it'd be interesting, but it's already up. They don't pay a dividend, so I'm not too interested. But yeah, all in all, this company is going to get a thumbs up, and I will see you in the next video.